Hello, good morning, everyone.
Good morning.
Good morning, Professor.
Good
Yeah, hi,
morning.
good morning, Kazuki. Good
Good
morning,
morning, Professor.
Angel. Good morning, Kyle. Hey, so we have seven, right? Seven people, and let me quickly check how many are on the today's forum. I see seven. Okay, so the numbers match. This is kind of uh, a little bit, disappointing because normally I should see like 11, at least 11. We have actually 13 on the roster. Was it 13 or 12? I've been, on average, having 11 people. Um, so let me just, hopefully the rest of the class will join us shortly. And I just want to remind you, this is a reminder, right? You have quiz one. You have quiz one starting today. Actually, it was previously scheduled to start at on 10th, which was yesterday. But then it was somehow that message didn't go out. But there was one student who somehow found it and did it already yesterday, submitted already yesterday. It's possible because in the assignments folder, this was already available from the 10th. And that student did relatively well, although it was just, the student just found it probably on the 10th and did it on the 10th. But that is there and it's due this Thursday. Okay. So to do that, we will have to finish this. So yesterday, we just we stopped here. We stopped here actually, and let's see. This is what's the magnification? I guess 75%. 70% is not that bad. Okay. And so looking at the structure, right? The big structure or the bird's eye view, right? The bird's eye view of the income statement. This is the bird's eye view of the income statement. So basically these, most fundamental components, income, expenses, right? You have to subtract expenses from income, of course, to arrive at some kind of profit. But that profit is not net profit yet. It's called operating profit or operating income and EBIT. And I said, this is why I don't like operating income. This is the term that's weird to be here. And I said, this is why I don't like, accounting's terminology. I don't like accounting, the way the accounting uses terminology because, but I understand. I mean, sometimes it is inevitable. But as long as we are talking about the corporate income statement, then calling this operating income is inappropriate. And then we understand, we will need to subtract interest from operating profit, and then that will be taxable income. Again, the term income is repeated here. But the term taxable income is quite commonly used. although the better word is net income in this place, but then we subtract taxes. But the term taxable income is so commonly used, we don't see anything weird about that. But actually, I'm telling you, it is not the most appropriate name to repeat the word income there, right? And then after subtracting taxes, then only then you arrive at net profit. But in accounting, they still call it net income. They still call it net income. But also it's called EAT. And I said I like the term EBIT, EBT, and EAT. And of course, you should know what EBIT stands for. It means earnings before interest and taxes. Okay, then earnings before interest and taxes is already self-fulfilling. I mean, self-explanatory or self-fulfilling. Isn't that right? It's self-explanatory. It's already also self-predicting, predicting what's going to happen next. Literally, yeah. Earnings, this is earnings. And so earnings is another name for profit. Earnings, right? Another name for profit. But it's the profit before paying interest and taxes. So the name is already logical and self-fulfilling, almost self-predicting and self-fulfilling, self-explanatory. So then it tells, we can predict what's going to happen next. What's going to happen next will be interest. Isn't it right? Because it says before interest and taxes. And then taxes, right? And again, this order cannot be switched. It cannot be taxes and interest. It can only be interest and taxes, right? Why? Think about it. They say interest, isn't interest the business expense? Interest is business expense. Isn't that right? Why? You needed interest. Interest is interest arises from the debt, right? So you have debt. And why did you incur debt? This debt is either the result of selling bonds or taking out a loan from the bank. And why did you do that? Because you wanted to, you needed that capital to expand your business. So it's purely the, and then if the interest arises from this debt, it's purely because of, you wouldn't have taken out that debt, you wouldn't have sold that bond if it wasn't to expand your business. But you incurred the debt because you wanted to expand your business. So this is purely business expense. This interest payment arises from the debt that you needed to expand your business. So this is business expense. And for business expense, you shouldn't pay taxes. You don't pay taxes on expense. You don't pay taxes. You pay taxes on earnings. You pay taxes on profit, right? If you pay taxes on expenses, that's almost like prohibiting any will to that's prohibiting. It's almost prohibitive, isn't it right? If you're taxing on the expenses, that's like discouraging any business mind. That's going to be discouraging any entrepreneurial activity or entrepreneurial motivation, right? It's demotivating entrepreneurial spirit, right? Of course, this interest will be taxed not from you, not on you, but from the lender, right? The lender who loaned out the money to you or the bondholders, right, that bought your bond, when they are paid interest, and when they sell the bonds, the capital gains and interest income will be taxed, right? Because it's their income. Makes sense? Because it's their income. Now then think about it. After paying out interest, then it becomes EBIT. EBT. And what does that EBT stand for? Now from EBIT, I drops out because interest has been paid. So then it's only natural, it only becomes earnings before taxes. Makes sense? It only becomes earnings before taxes. So you pay taxes, then finally you arrive at EAT. And what is that? Earnings after taxes. Earnings after taxes, right? So this terminology, which is accounting's terminology, but I generally don't like accounting's terminology that much. I mean, it's not the matter of like or dislike, but I mean, income, the repeated use of income, recurring use of income, I don't like that. But the terminology like, EBT, EAT, EBIT, I like that because it's so logical and so self-explanatory, right? Do you agree, everyone? Don't you think? Huh? Don't you agree?
Yeah, the EAT and
Yeah,
EBT, I understand.
yeah, that sounds quite logical, isn't that right? Yeah. Now I have 9 people. Okay, good, good. Hopefully, two more people will join. So, next, but basically, this is the end. This is the end of the income statement. In other words, this explains why income statement is also called P&L statement, P&L, profit and loss. But this can be positive, net profit can be positive or negative. If it is negative, that's loss. Okay? And this is why income statement is all about profit. Income statement is the goal of the income statement is to describe the process leading to profit. And I told you as we began this topic, I told you the purpose of income statement and balance sheet are totally different. The purpose of the income statement is to describe the process to arrive at profit, but the purpose of the balance sheet is to describe the capital structure. So they have two different purposes. So the line items constituting these two statements are different. Okay. Uh, the only thing that would be common would be the depreciation, and if ever depreciation and interest. Only these two items can occur in these two statements, but otherwise, all the line items are completely different. All the line items are completely different. So here, once again, okay, in the income statement, we have depreciation here as part of the operating expenses, OPEX, and also you have depreciation also in the balance sheet. You can have interest payment, interest in the income statement, and you have accrued interest, accrued wages, and accrued interest in the balance sheet. But otherwise, all the line items are completely different. I said OPEX, operating expenses, which is indirect cost, is called total fixed cost in microeconomics, but it's not exactly the same thing. I said it's roughly equivalent, and I said total fixed cost. Fixed cost mainly focuses on initial investment, which is also called the sunk cost. So what is the initial investment? Initial investment is literally think about it. If you are a manufacturer, what is the biggest, what is the the biggest characteristics of manufacturing? What's the biggest characteristics of manufacturing? Anyone? What's the what sets manufacturing apart from retail? Hmm? The business can be either manufacturing or retail. Of course, there's financial services, but it's either manufacturing or retail or service industries. What do you think is the biggest difference? Or hmm?
Production.
Production. Okay, you mean manufacturing produces something, right? Manufacturing produces something.
Yeah.
Well, then, doesn't service industry produce something? Hmm? Doesn't service industry produce something? I mean,
Well, yes.
Yeah, service industry produces something, but service industry's product is intangible, isn't that right? Whereas manufacturing's uh, output is tangible, isn't that right? So,
Yes, sir.
yeah,
I
go
would,
ahead.
I would like to just add on and say that manufacturer focus on mostly just producing the product, designing the product, focus on the quality and the quantity of it, and then the wholesalers' job is to make sure that they are selling that amount of quantity that was created from a manufacturer by promoting it and using other strategies to sell it. So their main focus is to buy the product and sell it. As a, for the manufacturer, their job is to, the original job of a manufacturer is to design, create a quality, quantity, and a brand in order to sell it to other people, to the retails and many other stores.
Yeah, sure, yeah. Malika, yeah, you, you summarized it well. Yes, but still, that is, yeah, expanding. You expanded on what I already said. Manufacturing, the clear, characteristics of manufacturing is that their product is tangible. They make tangible products, right? Whereas service industry produces intangible products. And of course, retail is basically distributing. Retail is taking the manufacturer's good to the consumers, right? And users. So yeah, Malika, I will give you 0.5 for that. Um, and Ian, I believe you also said, production. That wasn't, I will give you 0.25 for that because um, that didn't exactly address the question. But the point is, the biggest characteristics of manufacturing is plant and equipment. Think about it. What other industries? Does service industry have plant and equipment? Does retail have plant and equipment? No, none of them need. None of them need. Neither of them need plant and equipment. Only manufacturing requires plant and equipment because without plant and equipment, you cannot produce a tangible product. Right? Makes sense? And why is this so important? Because it takes a lot of money. Isn't it right? And that kind of, think about it. You have to have, before producing anything and selling anything, you must have plant and equipment in place. And it doesn't come for free. It costs money. Isn't that right? Suppose you are a computer manufacturer. You will have to have a plant first, plant and equipment first. And it isn't cheap. You have to build the plant and put equipment into it. It's going to cost you like, tens of millions of dollars or even hundreds of millions of dollars. Right? It is, and it must be already invested. In other words, the plant must have been completed already. Equipment must be already in there, in the plant already, before you start the production. So you don't see any income, any money, right? But before even you start the production, before you start making any money, making any revenue, you must have plant and equipment. You must already you must already invest in this project. You must already invest like hundreds of millions of dollars, right, into this project, into this business, before you see any income. Make sense? And the construction will take at least a year or two. The construction cannot be finished overnight. So for the first 2 years, right? For the first 2 years of this project or for this business, you won't have any income, but only investment. Initial investment is negative cash flow. Negative cash flow. You understand? Negative cash flow means, the money goes out. It's cash outflow from you with no cash inflow during the same period. The cash inflow will start only after the project is completed, and then when you start the production, and the production brings in the first round of revenue. So there's a gap. That's why it is called sunk cost. It's called sunk cost, right? There is a cost that's already been sunk into this project, which would be like, millions of dollars before you earn even a single dollar. This is the significant difference between retail and manufacturing, and between manufacturing and service industries. Because retail, you don't need plant. You don't need plant and equipment. All you need is just some retail space. You can lease it, and then as soon as you lease it, you can just stock it up with the merchandise. So in the first month you started the business, you can turn in profit. You have sales revenue in the first month you started, right? That churns in profit. Service industry as well. I mean, if you're a lawyer, if you're an accountant, you just lease an office, right? Start advertising and promoting your business. You bring in, basically, if lucky, you get already, a lot of, clients, even in the first month, right? And from the income generated from the first month, you can pay the rent from the second month. Of course, first month rent, it will have to come out of your own pocket. But from the first month, you can already, it generates the income to handle the fixed cost, fixed expenses, right? Operating expenses, like rent, even from the second month. But then manufacturing is not like that, right? Isn't that right? Manufacturing, you have to be patient. You have to first invest a lot at time zero, right? And wait 1 year or 2 years for this business to actually generate income. And also that's why manufacturing is hard to close down. I mean, in retail, if the business is not doing well, you can just close it off. You can just close it off and just move to another location, or you just need to get rid of your inventory. You can get rid of your inventory by putting it on, like, fire sale, or you can use inventory liquidator, right? But you can easily, close down and open up another in another place. Or yeah, lawyer, doctors. If your business is not doing well, you can close down and move to another location. But you might wonder, what about the clients that have been, well, your business has not been doing well, that's why you're closing down. You don't really need to worry. There isn't that many clients to worry about. Isn't that right? So this has so much ramification. I mean, so much ripple effect throughout the economy. Think about the manufacturing. Manufacturing hires workers, right? Manufacturing hires workers. But these are skilled workers, not unskilled workers. In other words, in manufacturing, the workers should be some trained people, skilled people. Like, if you're on auto, assembly line, you have to be a mechanic, some kind of, people with, training, and they have, license for their training. And so the job will be permanent job with, so there's a job security, and there's a relatively good pay. But compared to that, retail, what kind of skills does it require? In retail, mainly the people, the workers in the retail industry are relatively unskilled people compared to the workers in the manufacturing industry, right? The skills that they, I mean, Walmart, let's say, you need to, you would be either, if you are working for Walmart, you would be either stocking the inventory, stocking the goods in the back room, uh, um, or just, organizing the display of goods, or cashier. If you're a cashier, um, you can consider that skill, but it's a skill you can just master overnight. I mean, it's not sophisticated level of skill. So what does that mean? There is no job security. In retail, there's no job security. They can easily hire and fire. Right? Makes sense? But in manufacturing, it's not easy to hire and fire. First, when you hire, you have to really make sure that these people are competent, that they have these skills, certain skill sets, and these people are not easy to come by. There is only a limited number of skilled workers, whereas there is plenty of unskilled workers. So unskilled workers are permutable. They can be replaced anytime. But skilled workers, they cannot be replaced that easily. It's hard to fire them. It's hard to fire. Not only because it's easy, it's not easy to find a replacement, but also because they are generally unionized, right? These skilled workers are unionized. It's hard to fire. Union will fight to. So then, think about it. Manufacturing gives job security. right? Manufacturing gives job security, and job security gives, stable income. Stable income means, uh, the basis for raising family, basis for settlement, basis for uh, buying a house, basis for uh, a stable community, a stable society. So this is the importance of manufacturing. Hmm? If it is not manufacturing, still, I mean, we are living in the age of fourth industrial revolution. I mean, fourth industrial revolution is called, IT revolution. IT. We're living in the age of information technology. So if it is not, and they say manufacturing is a goner, right? We no longer, I mean, manufacturing is dirty industry. That the image of manufacturing, traditional manufacturing is smokestack. The factories with smokestack polluting, right? And yeah, there are old manufacturing style, old manufacturing industries are usually dirty, polluting industries. But these days, manufacturing. I mean, think about it: computers, electric cars, electric vehicles, mobile phones. Uh, there is, to some extent, they pollute a little. They pollute too, uh, like chemicals. The chemicals to process the microchips and things like that. They are polluting the environment. That's true, to some extent, but much cleaner compared to you know um, the conventional image of the manufacturing industry. But still, think about it. The IT industry, uh, you need to have skills to work in the IT industry. You have to have at least some degree in um, computers, or computer science, or computer engineering, or information technology, and you know um, networking, cybersecurity, coding. Uh, it requires skills. And as long as the workforce is skilled, they cannot be easily fired, right? There's job security. That's what's important, right? Whereas retail, no job security. That's why Walmart and Amazon have been the target of, um, the movements like, Occupy Wall Street, because uh, Amazon have been notorious, and Walmart more notorious, infamous for paying very low minimum wages and over sweatshopping these workers. Amazon has been very infamous for sweatshopping their workers. And it's easy to sweatshop them, because uh, if they don't, abide by the company regulation or policy, then they can be easily replaced. They can be easily replaced. Okay. Um, so that's why you need to have an advanced, at least bachelor's degree, right? And but at least bachelor's degree, not in something like history or philosophy, right? But something that is that can give you a job security, something that can give you a cutting edge, right? Something like
Like
finance.
experts, for example.
Huh? Say that
Uh,
again?
like communication experts, for example.
Communications, I'm not sure in what
Like art,
communications. Hmm?
like not just like customer sales rep, but just like I forgot the exact term I'm looking for. Sorry. But those people get the degrees in communications and those type of career
Yeah,
fields.
yeah. Well, if it is journalism, I mean, a communication related to journalism, um, it's also a very competitive field. I mean, if you are thinking of a job in, like um, journalism or media, news media, um, uh, or like magazines, this is a field that I wouldn't say um, job security is universal, right? It could be. I mean, you can be a star. It's almost like you can be a star player in this field um, if you're good. Uh, but if you are not very, talented, uh, it's a field that doesn't cannot guarantee job security, honestly, right? Um, uh, is that Kyle? Hmm? Kyle, I don't know if you seem to be on the phone, so maybe that's the reason. But sometimes it sounds muffled. Your voice sounds muffled. Uh, but yeah, yeah. If, I hope I could, I have answered your
I
question.
switched over to the phone today.
Hmm?
Yeah, I switched over to the phone today. I don't know if it
Oh,
might
okay.
give
Yeah,
an audio.
yeah, but yeah, the downside of the phone connection is that it gets muffled. Your voice gets muffled. But yeah. I hope you have, I hope I have answered your question. Now, where was I? So,
Professor,
yeah.
I also had a quick question since we were talking
Mhm,
about the retail and the manufacturer, right? Um,
mhm.
I was very confused about the part. So manufacturer also creates the product and everything. Whose job is to promote the product? Is it the person who's manufacturing the product or the person who's selling the product?
Oh, it can be shared. It can be shared. One, first of all, if if the if it is a small what they call convenience product, something like a bag of potato chips, something you can find in a convenience store or in a uh, uh, usually it is promotion is borne by the manufacturer because think about it um, the brand you don't necessarily buy a bag of potato chip. Uh, 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 it's not a big stake. It's not a big stake item. I mean, you don't. Uh, your risk is very minimal. I mean, if you suppose you bought a bag of potato chip and it wasn't to your taste, it was bad. You just you just risk about $3. Your stake isn't that high, right? And so uh, and if a I mean, it's not. And what's the difference? I mean, you don't. It's not Frito-Lay potato chip may not be superior from. I mean, it's just a matter of personal taste. Some people prefer Frito-Lay. Some people prefer Lutz, or some people, But the difference is very minimal, right? Difference is very minimal, and it's only a matter of personal uh, taste. Then in this case, um, and the the share of oh, my voice is being echoed. The share of profit from selling one bag of potato chip is also very minimal to the retailer, isn't it right? And why is my voice echoing? This is interesting. Um, so the profit profit that goes to the retailer, maybe a few cents, maybe 20 cents to the retailer, but so they have to sell a lot for a retailer to make decent profit from potato chips. They must sell a lot. But even if they sell 1,000 bags per month, that only comes to, I don't know why my voice is echoing still. That only comes to like, a few $100. That only comes to a few $100 to the retailer. So the stake is greater for the manufacturer. The manufac the manufacturer would sell like tens of millions of potato chips a year. Then the profit to the manufacturer is much greater. So it only makes sense for the manufacturer to promote, right? And maybe you have seen the commercials of potato chips on TV, which is run directly by the manufacturer, but not by retailers, right? Makes sense? But then if this is not a convenience good, but if this is a more what they call shop around good, like, yeah, I wonder if anyone else has audio issue, because I have an audio issue, because I hear myself back. I hear my voice echo back. Do you get the same thing? Do you
Yes.
hear echo of my
Yeah.
voice?
Your echo
Oh,
is very bad.
I don't know why this is happening. Maybe I might. Uh, okay. We'll see why is this happening. All right. How does that sound? I don't hear my voice echo.
I think it sounds better.
Okay. Something just happened. Something just happened without, it wasn't me. Something just happened a while ago. What's going on? I'm reconnecting. Oh, so it wasn't me. I think it's the blackboard. Okay. I think it was the blackboard. Okay. It's better now. Yeah. And then think about it. For a merchandising, a good major. It could be, yeah. Who was asking this? Whose question was this? I think it was in the chat box. Darlene. Yeah, merchandising. Yeah, this could be a good major. I mean, I don't know if there is a separate major for merchandising, but it would be under marketing, I believe. Um, Depending on, but also, if you're a merchandiser, usually you're on the uh, buying end. Buying end. I mean, uh, in B2B, business to business, you're at the buying end, and you are basically merchandisers are usually, the term that is used in the fashion industry, right? Merchandisers generally like outsource or source the manufacturer, right? In like, apparel, garment and apparel industry, there are so many small manufacturers, um, small in merchant in fashion and garment, the manufacturers are relatively small, whereas, in automaking, automobile manufacturing, computer manufacturing, manufacturers are giants. Okay, I don't want to digress too much because I got too much to cover, and I don't want to spend time on something little, not totally unrelated, but just a little related. Merchandisers are someone who basically outsources, right, from these small manufacturers, right? I mean, you are working for merchandisers generally work for like department stores or retailers, and then they buy from uh, these small manufacturers. Um, so depending on how, also you must have then obviously business sense and also like fashion sense. I mean, you should be able to tell whether this model will sell or will not sell. You must have that sense, right? And if you're good, so it requires some talent. Uh, if you're good, um, you'll be, obviously a star merchandiser who can be uh, sought after by many different department stores or retailers, right? Uh, okay, I'll just have to wrap it up there. And so here, yeah, that's what initial investment or sunk cost is, and we'll spend too much time on that. So here, so this is the end of the income statement, but it can go further. Why? Because I'll use a different. So from now, think about it. The profit, uh, net profit or EAT, right? Net profit or EAT. It belongs to the. Who does that belong to? Who does that net profit belong to? Hmm?
The business.
Yeah, but what is business? Is by business, what do you mean? The
Company.
the company, or I mean, the company or the owners of the company? Which one do you mean?
The company, because only the capital belongs to the owners.
Yeah, but look, a company is only a vessel. You understand? Company is an inanimate being. A company is an inanimate entity, which is called, legal person. But legal person is an inanimate entity. It's not a real person. You understand? Um, uh, if you think about it, a company is let me. A vessel only, right? A vessel for what? A vessel for funneling the profit to whom? To the owners of the company. To the owners of the company. And who are the owners of the company? Hmm? Who are the owners of the company? Think about it. A company cannot. A company is just a legal structure, right? And the company cannot spend that profit. In other words, does the company use the profit to buy clothes and wear it? Can the company use the profit to buy something and eat it? No. Company is only a structure, a legal entity, a legal structure, which is only acting as a vessel, right, to funnel the profit to the owners of the company. And who are the owners of the company? Hmm? The owners of the companies are the shareholders. Okay? It's the shareholders. Think about it. Eventually, the profit belongs to the shareholders. Profit belongs to the owners. I mean, a company can be either a sole proprietorship, right? Owned by a single person, single owner, or it could be a partnership, or it could be a corporation. And of course, large companies are mostly corporations, because large means what? Large means what? A large corporation, a large company can be sole proprietorship as well. I mean, theoretically, there's no reason it cannot be. But a company is a large company means basically what determines the company, a business is large or small? What determines if a company is large or small? Anyone?
Occupying the largest market share.
Oh, that's one good, yeah, that's one good way. That's, yeah, occupying the largest market share. But to occupy a large market share, so that was Yang, right? Yang, I'm giving you a 0.5 for that answer. Yeah, that's one. But to occupy a large market share, what should a company be like? What should be a company? What should the company be like? It should be, of course, it should be a large company. But large company, how do you determine the large company? It must occupy a large market share. But to occupy a large market share, the company must have, to occupy large market share, that means the company must have a large output, think about it, large market share, large market share. But to have large market share, what should it be? What should it be capable of? It must have a large output, right? Large output means production level, right? A large production level. Think about it. You cannot occupy large market share without large production scale. You must be able to supply. You have to be a major supplier in the industry. But then to be able to produce such a large scale, you must have massive production capacity. And the massive production capacity can only come from what? What do you think?
Capital.
Yeah, large capital investment. In other words, large production capacity means, massive scale plant, right? Massive scale production facility on a massive scale. And the size of the plant is determined by the size of the plant is physical capital, right? large fixed assets. Large fixed assets, right? Large fixed assets, in other words, that means or large, physical capital. Physical capital, which is, basically a massive capital investment. It comes only from massive capital investment. Isn't that right? Didn't I tell you, right? Remember when I talked about fixed cost, right? Total fixed cost, it's initial investment, sunk cost. So the initial investment determines the size of the company, size of the plant, okay? Size of the plant. And the size of the plant, think about it, with $1 million, with $10 million, you can build a plant that can produce 10,000 computers per month, 1,000 computers per month, or 10,000 computers per month, with a $10 million investment. You can build a plant that can produce up to 10,000 computers per month. So then if you if you want to double the capacity, then the investment must be doubled. In other words, you must build a plant with $20 million. You must invest $20 million, and the size of the plant will double. And if the size of the plant doubles, then the production capacity also doubles. Then that means you can produce 20,000 computers per month. Right? It's not exactly that linear, but the logic is very solid. The logic is very clear. So here, the term fixed assets, the term fixed assets or physical capital comes up here, which is related to the balance sheet, because the balance sheet is showing you now plant and equipment, land and building. These are physical capitals or fixed assets. Okay, physical assets or fixed assets or physical capital, and they are basically plant and equipment, and they determine the production capacity. Production capacity determines the market share, because production capacity is the supply capacity. And the bigger the production capacity, the bigger your market share, right? And the size of the plant is determined by the initial investment. And of course, assets fall into two categories: current assets, which are also called liquid assets. In other words, they are not physical. They are mostly financial assets, liquid assets. Whereas, non-current assets or fixed assets are physical in nature. And so together, it's called total assets. Okay? So we've come to the conclusion that the size of the company is determined by total assets. Okay? Some people say, how many people they hire, how much is their annual revenue, annual income. Look, think about it. How many workers they hire, how much annual income they make, it all depends on the total asset size. doesn't it? It all depends on their output capacity, right? And their output capacity is determined by their total SSIs, and which comes from their initial investment. Make sense? Which comes from their initial investment. Size of the capital that's initially invested determines the size of the firm, and the size of the firm determines their presence, their supply capacity, and their supply capacity determines their market share, and their market share determines their presence, their status in the industry, right? But again, the whole we come back to the question. Yeah, the corporations, I mean, the companies can be, no matter how large or small, it can be sole proprietorship or partnership. But most likely, if it is a large company, it will be a large corporation, because large corporations have more. What does the corporation means? What? The capital investment came from the investors. It came from shareholders. So if your initial capital came from like 1 million investors, and more than the majority of them institutional investors, not 70% of the initial investors were institutional investors, not individual investors, then how much capital can they tap into? They can tap into a huge capital. I mean, one single owner of the business, there's a limit to how big that business can be. Does that make sense? Everyone? Does that make sense?
Yes.
Okay, only one person?
Yes, Professor.
Okay, all righty,
Yes.
2 people.
Yes.
All right, 4. Only 4 people.
Yes, it makes
Agree.
sense.
All righty, darling. All righty. So I think the time is like 1:05 now. I think this is a good time to take a break. So let's take a 10-minute break and come back at 1:15. Okay. All righty. All right, we're back. We're back. Let's continue with uh, uh, who the profit belongs to. Profit belongs to the shareholders because shareholders provided. Okay, this brings up the liabilities and equity side. So in our example, let's say out of the total assets, right? We can easily find total assets for this company. I mean, I can. We're gonna have to do this again later, but this company has almost like $10 million total assets. Okay. All right, and then I'll have to. There's nothing there yet. So. Okay. This is incomplete as it is, but when it is complete, then you will see this is this is almost 10 million, right? It's not but but anyway, this 10 million, right? Assume it is 10 million. Total assets of 10 million. What's the source of this 10 million? Where did it come from? It came from only two sources. One, the equity. The other one, liabilities, total liabilities. Okay, equity, liabilities are debt. So equity and debt, and equity is the equity is the profit. I'm sorry, equity is the capital provided by the shareholders. Okay, shareholders are the owners of the company. You might wonder, the total assets is 10 million, and they only provided 40% of 10 million, and how can they be owners? Look, the other 60%, right, 6 million, came from the lenders or the creditors or the bondholders or the debt holders. That means 6 million is the loan. Just because they loaned 6 million, that doesn't make the lender the owner. Lender is only a lender. Lender gets, for that 6 million that they loaned, lender gets interest, right? And at maturity, they will get their principal back. So interest is, I've been telling you, interest is an obligation. There can be no loan without, I mean, if I can borrow money, if I can borrow $1 million, regardless of whether I can pay or interest or not, that kind of, there's no such thing. There can be no such thing, right? As optional interest loan, right? Loan with optional interest. If they cannot get the interest, then they won't lend. Make sense? So they get secure. They get secure payment of interest. Secure payment of interest. And then they get their principal back at maturity, right? That's the nature of loan. So lenders cannot become owners. Lenders are lenders. Owner, if you invest equity, that means if the company makes no profit, then there's nothing that goes to the owner. Think about it. Owner is someone who makes nothing when the company makes zero profit or loss. If the company makes loss, it doesn't hurt the if the owner is the sole proprietor, it will hurt the finance of that individual, because in sole proprietorship, the owner's money, there's no line between the owner's finance and the company's finance, because company and the person, the owner, is one and the same. Okay, that's the sole proprietorship. But in a corporation, there's a separation between owner's personal finance and the company's finance. You understand? So even if the company loses, it's the loss of the company, not the owners. Make sense? But if the company makes profit, that belongs to the owners, right? In sole proprietorship, of course, you are it's a sole proprietor. You are the only owner. If company makes profit, it's your profit. If the company has debt, and you have to pay that debt out of your own pocket, because it's a sole proprietorship and you're the owner. It's a one-man business, basically. So the company's debt is your debt, right? But in corporation, the company's debt is company's debt. It's not your debt. Company makes loss, it's not yours. The company's loss. Company makes profit. It doesn't, listen, it eventually belongs to the owners, shareholders, but it doesn't have to be distributed immediately. Okay, you have to understand this. It doesn't have to be distributed. The profit doesn't have to be distributed, but it belongs to you anyway. It belongs to you. So think about it. The stake, equity holder is the shareholder. Equity holder is the owner. It's the shareholder. You have to be flexible with these names, and you should be quite comfortable with these names. Okay. First of all, debt holder is the same thing as bond holder. If the debt is bond, it's the same thing as lender, which is the same thing as creditor. Okay, and then equity holder is the same thing as shareholder, which is the same thing as stockholder. and which is the same thing as owner. So think about it. Owner takes the fall. Eventually, if the business fails, owner takes the fall. Owner will lose. If this is a sole proprietorship, the owner will lose not only the company but lose the his or her personal assets or wealth, part of it. Not maybe not, because depending on the size of the debt, it may not entirely eat up the person's entire personal wealth. But in case of corporation, if the company fails, the owner's loss is limited to his equity holding. In other words, if I invested $10,000 into this company X, so that means I bought $10,000 worth of stocks of company X, and if company X goes down, I only lose my $10,000. It doesn't. I don't. They don't come after my personal assets, right? Personal wealth. I just, but that's the owner. Owner is the one who takes the profit if the business does well, and if the business fails, then the owner takes the fall. But the lender doesn't take the fall, right? Lender will get fixed income, which is interest, whether business does well or not. But if the business fails, the lender will have claim, because the lender hasn't got their principal back. Okay, so then what does the lenders do? Lenders can sue this company in the bankruptcy court, take this company to bankruptcy court, and in case this company has physical assets, like if this is a company with a manufacturer, if this company is a manufacturer and has plant and equipment, because if they cannot pay the lenders, if they cannot pay back the lenders, it's just because they don't have cash flow, the liquidity. They don't have the liquidity, the cash flow, right? So, but then they have, plant and equipment, the physical assets. So what do? Then they will sue this company in the bankruptcy court and get the bankruptcy judgment. And based on the bankruptcy judgment, they can seize the company's physical assets, and they sell it off, and turn it into money, turn it into cash, and then they take their cut, right? Of course, in case, think about it, that's called Chapter 6 bankruptcy, Chapter 7 bankruptcy, and then if it is retailer went bankrupt, then retailers have merchandise, the inventory, and if the merchandise value, inventory value is most of the cases may not be 100% of the total amount of debt, but if it is more than 100% of, or 100 or more than 100% of the total value of the debt, then they will certainly get the bankruptcy judgment and seize the assets, and they will sell it off, recover 100% of their principal, right? But if they're but then also think about it, if the inventory of the retailer or the plant and equipment of the manufacturer, the total value of that is not even 50% of the total amount of debt, right? Then it's better not to seize and sell these assets because they cannot even recover 50%. What do? Then they work it out. It's called Chapter 11. They let them leave. They let them leave, go on, and then there will be a court-appointed manager. There will be a court-appointed manager, and the court-appointed manager. Think about it. Normally the management will be the management will serve the interest of the owners or the shareholders, but then court-appointed management will serve primarily the interest of the lenders. So whatever the company makes, then it will first go to pay off the principal, the debt of the lenders. Okay, does everyone follow?
Yes, this makes sense. Yep.
Yeah. Okay. Good, Stephen. I thought you would definitely make sense of that. So here's the thing. I said owners. So the profit belongs to the owners. I wrote a lot here. But I told you it doesn't need to get distributed. Why? It doesn't need to get distributed. Why? So I'm gonna have to. Maybe I can. Let's see if I can move this. Can I move this? Yeah, I can move this. Yeah. What is wrong? I can't. I should be able to. Then I should also be able to move this. No. Oh. Okay, and it got so small. All righty. Now think about it. You're an Apple shareholder. How do you claim Apple made, let's say, Apple made, let's say, $1 billion profit last quarter. Let's say Apple made $1 billion profit last quarter. How do you claim that profit? I mean, you're an Apple shareholder and you have, but you own 1,000 shares of Apple. 1,000 shares of Apple. And what is your portion of that $1 billion profit? I don't know how many shares are outstanding for Apple, but total number of shares outstanding, Apple's total number of share, let's say Apple's total number of shares outstanding is 10 million, let's say.
Actually, it's 16 billion.
Say that again. 16 billion?
Yeah.
16 billion or 16 million?
16 billion.
Is that 16 billion? Okay. Yeah, it could be. But, let's assume, just 100 million. Let's just assume 100 million, right? Just for the argument's sake. If you have 1,000 shares, and if 100 million shares are outstanding, and 100 million is 6 zeros, right? Million is 6 zeros. So these 6 zeros out of 6 zeros, 3 will cancel out, 3 will cancel out. So your portion is 1 over 100,000. 1 over 100,000. So if Apple's net profit was $1 billion, 1 billion, which has 1 billion has 9 zeros, right? 9 zeros. But you can calculate it. You just cross out 5, and then so it will be like out of 1 billion, right? 9 zeros. You will have 4 left. 4 left. So your proportion of that 1 billion will be, 10,000, just 10K. But how do you claim it? You're going to go to Apple's headquarters. Apple is located in, I believe, San Jose, California. You go there and knock on the door. Give me my 10,000. You're going to do that? No, that's totally unnecessary. And they're not going to distribute it to you. So think about it. Theoretically, what happens is, suppose, if Apple have 1 million shares, currently, let's say, Apple is, I believe, like, let me quickly look up. Was it 200 something or, let me go to my, where is Apple? What happened to Apple? This is, yeah, there. Yeah, 174. Suppose, suppose Apple is, just to make it simple, when you bought Apple, let's say when you bought it, and suppose you bought it at the end of the third quarter. So the price at the end of the third quarter, you paid this price, and it was 150. And you bought 1,000 shares. So obviously, that's what your total equity position in Apple was 150K, isn't it right? 150K. And then so the price at the end of the fourth quarter, I mean, we are getting, fourth quarter would be somewhere around 200. Let's say it's somewhere around 200. Then obviously, and so to make the story consistent and congruent. So there were 100 million shares outstanding, and fourth quarter earnings was 1 billion. So fourth quarter earnings was 1 billion. 1 billion over just simply I'll just do it on a calculator. It's 1 billion has 9 zeros. 100 million has how many zeros? 7 zeros. 7 zeros. The difference is 2 zeros, right? So the earnings per share is 100 then. Isn't it right? Earnings per share is 100. So the fourth quarter earnings per share is 100. So fourth quarter, fourth quarter earnings per share is 100. Then if this is correct, if the market price, currently the market price is correctly priced, right? But actual market price would be slightly, off. But once this earnings per share information is out, once it is released, then the fourth quarter price must be 250, right? It will have to reflect exactly the earnings per share for fourth quarter. So the end of the fourth quarter price must be 250. Of course, this is called book value per share, only book value per share, because it's book value per share at the end of the fourth quarter, right? Because that's exactly based on the book data, right? The market price, actually, the market price could be slightly market price can be a little different. Market price, and since this company did, Apple did very well, if this is the case, they made, almost 67% profit. They made almost 67% profit in just a single quarter. Then obviously, there will be a lot of, there will be a lot of positive expectations built around Apple's share price. So the market price will be somewhere around 250, mostly greater because of the positive expectations. Okay, now think about it. You want your money back. I mean, in other words, you want this profit. You want to recoup this profit. What do you need to do? You don't need to, request it. You don't need to request it of Apple. You can simply sell it. If you sell it, you basically you paid 150 at the end of the third quarter, and you sell it for 250 or above. You will be realizing $100 gain, capital gains, right? Over just one quarter, and you had 1,000 shares, so total you will recoup $100,000. Okay, so this is how the owners recoup their profit. Once again, owners don't have to ask the company to redistribute the profit. There's no need for that. Okay, there's absolutely no need for that. That's basically, and that's why there's a market. I mean, you bought the stock in the secondary market from someone who was holding Apple stock before you. I mean, this is something I throw all this all at the same time, so it can be confusing. But you don't buy stocks directly from Apple. I mean, that's called the primary market, and only institutional investors are invited to the primary market. An IPO, you're not invited to the IPO. It's not, IPO is not a market that is open to anybody and everybody. Usually you get invited to IPO. And if you are an institutional investor, large institutional investor, you get invited. If you are an individual investor, but if you have a large position with a broker, the broker will invite you. But if you have only like, less than $100,000, with the broker, you generally don't get invited. Maybe, sometimes if you know someone, you may peek into IPO. So you're not generally buying and selling stocks in the primary market, which is IPO. And after IPO, it's all called secondary market. So all transactions are generally all secondary market transactions, right? I bought my Apple shares, 100,000 shares of Apple or 100 shares of Apple from the secondary market, meaning, you bought it from someone else who used to hold, Apple shares. And then you can sell it. When you sell it, it's still the secondary market. Someone else will buy it, from you. Of course, it will be through the broker. It will be brokered. Again, the profit belongs to the owners, but it's not distributed. But income statement ends here, but it doesn't really end here. Only the income statement ends here. Why? Because after that, from the EAT, the stocks pay dividends. I mean, it's not an obligation like interest. Interest is an obligation, but the dividend is not an obligation. Companies may or may not pay dividends depending on their financial situation. I mean, if the company needs to grab every penny to reinvest in the growth of the company, they won't pay dividends. Okay, so usually the growth firms, what they call growth firms, the companies that are growing fast, they don't pay dividends because they need everything. They need to grab every penny to reinvest in their growth. But the shareholders are not disgruntled about it because they know by reinvesting all the profits into growth, then the stock price will reflect it. The next time, the stock price will be higher, reflecting it. And then when they sell it, they all recoup it, right? But so a dividend is not an obligation, and that means the companies that are not fast growing can have a leeway to pay dividends. I mean, they are more in a flexible position. So if they pay out dividends, dividends come out of this. Okay, once the dividends, so dividends could be, depends on the dividend payout ratio, could be 10% of the earnings, 10% of the EAT, or whatever. But if it is 10%, 10% of the EAT will come off, paid out as distributed as dividends, and whatever is left is called what? Anyone? Does anyone have any idea what is called? After paying out dividends? After paying out dividends is called retained earnings. Okay, it's called retained earnings. So then retained earnings are literally retained within the company, but just holding the cash doesn't earn anything. So the company would retain. What do they do with the retained earnings? The company has two choices. One, they reinvest it in their own growth. But think about it. Here's the dilemma. If this is a fast-growing company, right? If this is a fast-growing company, growth company, the growth rate, their growth rate can be greater than the average market return, because of course it's a fast-growing company. Their growth rate will be greater than the average market return. Then they will reinvest in their own expansion. However, it could be like this. I mean, if this is a mature company, mature sounds good, but actually mature company means it doesn't grow fast. Their growth rate can be lower than the average market return. If it is lower than the average market return, what would they do? It's better to put that retained earnings into the market stock index fund. Make sense? The companies that are not growing at a high rate, and especially if they are growing at a slower rate than the average market return, it only makes sense. It only makes sense to invest that money not into themselves, but into the market index fund, which will most likely give better return. I mean, this will eventually be better for the shareholders too, right? Okay, this is something you can, I mean, everything here is logical. Logical is, in economics and finance, the rationality. What is rational? The rationality is clear. More is better. More is better, right? It's always more is better. Some people say, small is better. Yeah, I mean, sometimes, that's true. I mean, especially, if you have Buddhist philosophy, minimalist, right? You don't want to waste a lot. You don't, but this is investing, you want to what? Maximize your return, right? Over the given input initial investment, right? Basically, what is efficiency? The concept of efficiency is, what is efficiency? Is maximum output over minimum input. That's efficiency. Isn't that right? Maximum output over minimum input. What is the productivity? Productivity is simply output over input, right? Output over input, that's productivity. But efficiency is maximum output over minimum input, right? And as the students of finance, we pursue maximum output over minimum input, right? This would be, I mean, if possible, of course, sometimes, if input is minimum, output would also be mediocre. But think about it. Think of it this way. You were born poor, completely born poor. And your parents had very little wealth. Of course, you were born poor, so your parents had very little wealth. And you had very unhappy childhood. But so you were barely, making it. You barely went to college and barely, but then since then, you ended up with a huge company called Apple. Think about Steve Jobs. Steve Jobs was even disowned by his own father and then, adopted by foster parents. And he didn't have wealthy, his foster parents or adoptive parents were not wealthy. So he just barely made it. He went to college, but he dropped out. But he became what? That's maximum output over minimum input. Almost infinite. The efficiency is almost infinite. But there are people who were born with, everything. A huge fortune, spoon in their, like a gold spoon in their mouth, and, almost born as the prince of an emperor, right? But then they ended up in ruin. There are many people like that. I mean, maybe not that many people. Some people who are born to a very wealthy family, but they are just used to such a wanton life. Almost they had everything. They don't know they don't have concept of efficiency. They don't have the concept of, so they just squander their lives, squander their wealth, ended up in, homeless shelter, or, that's minimum output over maximum input. That's obviously, that's the worst case scenario, and that's very stupid. And that, there are, throughout the history, there are many monarchs, I mean, the princes who were born as the crown prince, I mean, the firstborn, but then they were crown prince, and they were so corrupted, so charlatan, corrupted, and they ended up eventually, on a guillotine. So why? I would say they were not really stupid, but they just didn't appreciate the concept of efficiency, right? Sometimes you need good input to result in maximum output. But if you start with minimum input and end up with maximum output, they deserve really a maximum respect, because they are the maximizers. They are maximum efficiency maximizers. And I personally, I have so much respect for people like that. That's the greatness, right? That's the greatness. Start out small, but end up in, infinite, infinitely large outcome. All right, so that the time is already Jesus, the time is already 2:01. Good time to take a break. Let's take 10-minute break and return at around 2:10, maybe 2:12-ish, 2:10-ish, okay? 2:10-ish. All righty. All righty. So 10 minutes. All right, we're back. We're back. So now let's think about. So we have covered almost everything about the income statement. But I just want to um, now I just want to talk about why I said income. I said I don't like the term income being repeated over and over. I mean, income is clearly a gross concept. However, um, but I said even though I don't like it, um, in a way it makes sense too, in a way, and I will explain it. First of all, uh, it's quite natural that when we have income and expenses, it's quite natural that we subtract expenses from income, right? Um, so, and the result is called operating profit. So, the reason it is called operating profit is because uh, this step or this process, I mean, subtracting expenses from income, this is called operating activity. Operating activity. Now think about it. What is an operating activity? I mean, operation. When we say, uh, of course, operation can mean surgery. I mean, medically it means surgery, right? Militarily, operation means, right? Military operation, operating a machine or, operation can mean a lot of things. But for business, right? And when they say, operating hours, hours of operation, I mean, you go to a bank or you go to a store, and on the door, they will have this etched, or they will have this printed on the door, hours of operation, 9 a.m. to 5 p.m. So we know what that means, they are open for business during those hours. But during those hours, what is happening? What is happening is exactly this. They sell something, right? And then they subtract expenses, right? And arrive at operating profit. That's the operating activity. And um, talking about operating activity is because all businesses all businesses engage in three types of activities. Three types of activities. What are those? Of course, one, it's operating activity. One, operating activity. Two, investing activity. Investing activity. Three, financing activity. So if you think about it, all the businesses engage in these three activities. And the operating activity is the most fundamental, most basic activity, because all businesses have to sell something, right? All businesses must sell something, and they must make profit. The only exception is nonprofits, right? Nonprofits don't necessarily pursue maximum profit, but they still need some profit. May not be maximum profit, but and the goal of all business, any business, is to maximize profit. Now, investing activity is basically activity to acquire plant and equipment, right? Acquire the assets that will be used in operating activity, right? Investing activity. Financing activity is basically how you finance that investing activity, how you raise capital to fund the investing activity. You can sell stocks, you can sell bonds, or you can sell your existing assets to fund the investing activity. Okay, so from here to here, from from here to here, right? That's called investing activity. Okay, now then what else was I? What else was I going to talk about? Oh, income. Now, the reason, and I told you, it's not right. It's inappropriate to call this operating income. I mean, because I've been telling you, income is always gross concept. But it is, sometimes it is, if it is business, it's right to call this operating profit. Okay, and call this taxable earning or taxable income, fine here, and net profit, not net income. But suppose this is not business, but an individual financial statement. But of course, individuals don't do this. You can do it for your own. You can do it for your own sake. I mean, I would like to keep track of my spending, and yeah, you can do this, but then it serves no tax purpose. I mean, the reason they do this, the reason the businesses do this, is to actually not only to know, of course, they need to know what their net profit is, but also this has a lot of implication. This has a lot of it has a lot of implication for taxes, because depending on and all businesses, not only businesses but individuals, if possible within the legal bounds, want to minimize on taxes. Who wants to pay maximum tax? You all want to pay minimum tax if possible. And the businesses have all the reasons and incentives to make this as small as possible, make the taxes as small as possible. But to make that, a lot of things must be supported by income statement, right? So the businesses keep income statement. Of course, basically the purpose is the profit, the process to arrive at profit, but to correctly account for taxes. Okay, to correctly account for taxes. But if it is not business, if it's individual, again, this doesn't, your, tax. I mean, you can roughly, arrive at the same, tax. You can roughly arrive at the taxable income doing it like this. But you cannot. You don't use this to present it to IRS, right? So for individuals, it doesn't serve that much purpose other than personal, for personal pursuit, right? But then think about it. If as an individual, your income will be mostly your labor income, isn't that right? Your income is earned income. As an individual, your income is not called revenue, but it's called earned income. Earned income is your labor income. But think about it. Your income is the result of selling your labor. Isn't it right? Everyone.
Yes.
Yes.
Yeah, of course. Your income is labor income. It's like revenue of for selling your labor. It's labor income. And then you also have some passive income. If you have savings, investments, if you have a rental property, you have, and if you have a copyright, you wrote a book, you authored a book, you have, royalty. All those things are passive incomes, right? And then you have expenses. For you, you don't have CGS, but you must have some fixed expense, like you have operating expense, you have fixed expense, which is basically your rent. Oh, and I didn't talk about the biggest chunk of the operating expense. Why it's called fixed? I'm gonna have to do that next time, tomorrow, because it's too late. Um, you have basically food, shelter, clothing. Food, shelter, clothing. Let's say that's your fixed expense. Food, shelter, clothing. You have to pay rent. You have to eat. You have to pay. You have to clothe yourself. This may not be fixed because you don't necessarily um, uh, buy clothes all at the same rate every season. Maybe I haven't bought any clothes myself for many years. My wife buys for me. Uh, uh, Sometimes I have uh, coats and jackets or pants that I haven't worn for decades, still just hanging in the closet, gathering just dust. Um, uh, but something like you have food, shelter, clothing, telecommunications, transportations. Those are fixed costs, right? You would most likely, and then some variable costs like entertainment, right? Entertainment, social life, nightlife, things like that, and that's variable. But it doesn't. The thing is, your variable cost doesn't uh, uh, contribute to your revenue, your income. But think about it. If it is your personal case, then what should this be called? Uh, uh, it cannot be called profit, right? It cannot be called profit. It should be called income, right? If it is personal case, and then and then you pay taxes, and after paying taxes, what should it be called? It cannot be called net profit. It should be called disposable income. For you, for individuals, it's called disposable income after paying taxes. Disposable income, right? Of course, and then the order is not the same. Your fixed cost is not business expense. None of this is your business expense, so they don't come before taxes. They don't come before taxes. Everything, your fixed expense must come from disposable income after paying taxes, right? Anyway, if you're getting a paycheck, your taxes are withheld already from paycheck. You don't, um, so taxes are already withheld from paycheck. So you don't pay taxes later. You pay taxes already when you get the paycheck. And at the end of in April during the tax season, all you do is simply um, uh, adjust. If you have overpaid, I mean, with the withdrawal from your paycheck, if you have overpaid through the withdrawal, you get the tax refund. If you underpaid through withholding in the paycheck, from the paycheck, you make that difference. You pay that difference, right? That's what you do in the tax season. All right. So I guess that's all the time we have for today. Okay. So I'm gonna have to, and I will talk about. I'll talk about um, uh, the operating expenses. I mean, I talked more about the sunk cost, but from the accounting perspective, what makes up operating, why they are uh, not why they are fixed cost, right? I'll talk about that tomorrow. I think I should have talked about that today, but it just skipped my mind. All right. Any questions so far? Any questions? Any questions?
No, Professor.
All righty. No questions, Kyle. How about the other people? Any questions?
No.
All right. Good. All right, Darlene, you had a question? No?
Oh, no questions.
All right. So I'll take it that, I'll take it as your, the answer from everyone. So I will call it a day now. Have a great afternoon. And don't forget you can do it on Thursday because we haven't completely covered this, but by tomorrow we'll be able to cover everything, I believe. I will see you guys tomorrow, 12 noon. And have a great afternoon. Take care, everyone. Okay.
Thank you, Professor.
All right. You're welcome. You're welcome. I'll stop sharing, stop recording, and sign out.